The United States Treasury will roll over $9.2 trillion in maturing federal debt over the next 12 months. That is not a forecast. That is not a worst-case scenario. That is the confirmed refinancing schedule published by the Treasury Department itself. And almost nobody outside of sovereign wealth fund reserve management divisions and central bank trading desks is paying attention to what that number actually means. Let me put that in context. 9.2 trillion is more than the entire GDP of Japan, Germany, and the United Kingdom combined. It is 32% of total US GDP being refinanced in a single fiscal year. And it is happening at interest rates between 4.0% and 4.5%, rates that are 200 to 250 basis points higher than the rates at which most of that debt was originally issued. The arithmetic is brutal and it is irreversible. At 4.25% average borrowing costs, the United States government will pay $391 billion in additional annual interest expense compared to refinancing that same debt at 2.0%. That $391 billion delta is larger than the entire federal budget for Veterans Affairs, larger than the Department of Education, larger than NASA, the EPA, and the State Department combined. Here is what most investors are missing. This is not a story about whether the United States can afford to service its debt. Technically, it can. The Federal Reserve can create dollars. The question is what happens to every dollar-denominated asset when the market begins pricing in the monetary consequences of that creation. The debt bomb is not the debt itself. The debt bomb is the refinancing wave hitting simultaneously with the highest interest rate environment in 16 years and a Federal Reserve that has lost the ability to cut rates without reigniting inflation that oil shocks have already embedded into the system. The number everyone is watching is the $36.2 trillion total debt figure. The number that matters is $9.2 trillion. That is the amount of debt coming due right now that must be refinanced at rates the Treasury has not had to pay since 2007. And the mechanism that explosion triggers when it detonates is something most retail investors have never been taught to see. Here is exactly what is happening and why the window to understand it is closing faster than the financial media is reporting. In fiscal year 2026, the United States Treasury faces the largest debt maturity wall in American history. $9.2 trillion in Treasury securities, bonds, notes, and bills issued at lower rates over the past decade are reaching maturity and must be either repaid or refinanced. Repayment is not an option. The government does not have $9.2 trillion in cash. Refinancing is the only path. And refinancing at 4.25% instead of 1.5% or 2.0% is where the mechanism begins. Every percentage point increase in borrowing costs adds $92 billion in annual interest expense to that $9.2 trillion. At current rates, the United States is refinancing Depression-era quantities of debt at interest rates that would have been considered restrictive in any prior economic cycle. The total federal interest expense crossed $1.03 trillion annually in fiscal 2024. That is more than the defense budget for the first time in American history. And that $1.03 trillion was calculated before the majority of the $9.2 trillion refinancing wave hit. By the end of fiscal 2026, if current rates hold, annual interest expense will exceed $1.2 trillion. By 2027, it will approach $1.4 trillion. That is interest expense alone, not principal repayment, not discretionary spending, not Social Security or Medicare. Just the cost of servicing the debt. Here is where things get important. The Treasury does not get to choose what rate it pays. The market sets the rate through bond auctions, and the bond market has been sending a signal for 6 consecutive months that most investors are reading exactly backwards. The 10-year Treasury yield has remained elevated between 4.0% and 4.5% despite a slowing economy, despite rising unemployment, despite every traditional recession signal that would normally send investors fleeing into the safety of government bonds and driving yields down. Yields are not falling. They are holding, and the reason they are holding is the mechanism most dangerous to every dollar holder on Earth. The bond market is pricing in supply. The Treasury is issuing $9.2 trillion in new debt over 12 months to refinance maturing obligations. Simultaneously, it is issuing an additional $1.8 trillion to fund the annual budget deficit. That is 11 trillion in total Treasury issuance in a single fiscal year. The largest supply wave of dollar-denominated government debt ever brought to market outside of a world war. And the buyers who absorbed that supply for the past 2 decades are disappearing. China, which held over 1.3 trillion in US Treasuries in 2013, holds 760 billion today. That is a reduction of $540 billion, a 41.5% decline over just 11 years. Japan, the largest foreign holder at $1.1 trillion, has stopped increasing its position and has been a net seller in multiple quarters as the Bank of Japan faces its own domestic yield curve pressures. Saudi Arabia, the UAE, and other Gulf petrodollar recyclers have reduced their treasury holdings by over $150 billion since 2022, while simultaneously increasing their gold reserves by 18%. This is not random portfolio rebalancing. This is strategic de-dollarization at the sovereign level. The Federal Reserve, which was the buyer of last resort during COVID, purchasing $4.5 trillion in treasuries and mortgage-backed securities, is now in quantitative tightening mode, allowing $60 billion per month to roll off its balance sheet without replacement. The Fed is not buying. It is selling passively, but selling nonetheless. That leaves domestic buyers, pension funds, insurance companies, mutual funds, and foreign central banks that are not China, Japan, or the Gulf states to absorb $11 trillion in new treasury issuance in 12 months. And the price they are demanding to absorb that supply is a yield of 4.25%. Not because the economy is strong, because the supply is unprecedented. Here is the mechanism step by step. When bond yields rise, bond prices fall. This is not theoretical. It is mathematical certainty. A 30-year Treasury bond issued at 2.0% loses approximately 40% of its market value when yields rise to 4.25%. The duration risk embedded in long-term government debt means that every percentage point increase in yields translates into massive capital losses for existing holders. Existing bondholders holding treasuries issued at 2% see the market value of their holdings decline as new bonds are issued at 4.25%. Pension funds holding long-duration treasuries have recorded mark-to-market losses exceeding $600 billion since 2022. Insurance companies, which are required by regulation to hold substantial treasury positions, face similar unrealized losses that erode their capital buffers. The Fed itself, holding $4.2 trillion in treasuries and mortgage-backed securities purchased at near-zero rates, is sitting on unrealized losses of $245 billion. Losses it is allowed to call deferred assets under central bank accounting rules but would be called insolvency under any private sector standard. Rising yields also increase the government's borrowing costs. The $9.2 trillion refinancing wave locks in those higher rates for years. A 10-year bond issued today at 4.25% commits the Treasury to paying 4.25% annually for a decade. If rates fall later, the Treasury is still paying 4.25% on that issuance. The debt structure becomes progressively more expensive with every auction. And here is the feedback loop that turns a debt problem into a currency problem. Higher interest costs increase the budget deficit. A larger deficit requires more borrowing. More borrowing increases supply. Increased supply pushes yields higher unless demand increases proportionally. Demand is not increasing. Demand is falling as foreign central banks diversify away from dollar reserves. The Treasury is trapped in a cycle where the cost of servicing existing debt is forcing it to issue more debt, and the act of issuing more debt is making all debt more expensive to service. This is the debt spiral, and it does not end with a default. It ends with a choice. The Federal Reserve will eventually face a binary decision. Allow Treasury yields to continue rising, making federal interest costs unsustainable and pushing the economy into recession, or intervene in the bond market to cap yields through some form of yield curve control or renewed quantitative easing. Both options carry consequences that redefine the value of every dollar in existence. This is not a hypothetical fork in the road. This is the documented endpoint of every debt cycle that reaches the configuration the United States has already entered. The Bank of Japan faced this choice in 2016 and chose yield curve control, capping the 10-year JGB yield at 0.25% for 6 years. The result was a yen that lost 30% of its value against the dollar between 2021 and 2022. The European Central Bank faced a version of this choice in 2012 during the sovereign debt crisis and launched whatever it takes bond purchasing programs that expanded its balance sheet by over $2 trillion. If the Fed allows yields to rise, the cost of servicing $36.2 trillion in debt becomes so large that it begins consuming an unsustainable share of federal tax revenue. In fiscal 2024, interest expense represented 18% of total federal revenue. By 2027, at current trajectories, it will exceed 22%. For context, when interest expense exceeds 20% of revenue, economists traditionally classify the debt burden as entering a danger zone where normal fiscal policy becomes constrained. If the Fed caps yields, it must create new currency to purchase the bonds that private markets will not buy at artificially suppressed rates. That is monetary debasement by definition. The purchasing power of every existing dollar declines as new dollars are created to finance government spending that tax revenue cannot cover. And the asset that benefits from that debasement is the one asset that cannot be printed, cannot be issued, and carries no counterparty risk: gold. Ray Dalio has spent 40 years watching sovereign debt crises unfold across dozens of countries and currency regimes. His framework on debt cycle dynamics is the most precise diagnostic tool in modern finance for understanding when a debt problem transitions from manageable to structural. And what he is observing in the United States in 2026 is a configuration he has seen before in every late-cycle debt crisis he has studied. In a recent analysis, Dalio identified the 3 conditions that historically signal a debt cycle reaching unsustainable territory. First, debt levels exceeding 100% of GDP. The United States is at 124%. Second, annual budget deficits exceeding 5% of GDP. The U.S. deficit is projected at 6.2% for fiscal 2026. Third, debt service costs exceeding 15% of government revenue. The U.S. crossed 18% in 2024 and is accelerating toward 22%. All 3 conditions are present simultaneously. And when all 3 align, Dalio's framework predicts that the government faces a forced choice between austerity, which is politically impossible, inflation, which is economically destructive, or financial repression, where the central bank monetizes the debt by holding interest rates below inflation, slowly eroding the real value of savings and fixed income assets. The United States has chosen none of these options explicitly, but the mathematics is making the choice regardless of political will. The $9.2 trillion refinancing wave is the mechanism that forces the choice into the open. Here is what most investors are missing. The debt bomb does not detonate when the debt reaches a certain level. It detonates when the cost of servicing that debt forces a policy response that undermines confidence in the currency. That moment is not arriving in some distant future. It is arriving in the 12-month window when $9.2 trillion in maturing debt must be refinanced at rates between 4.0% and 4.5%. Let me walk you through what happens next in the only 2 scenarios that are mathematically possible. Scenario 1, yields stay elevated. The Treasury continues refinancing at 4.25%. Annual interest expense reaches $1.4 trillion by 2027. The federal government is forced to cut discretionary spending, raise taxes, or run even larger deficits to cover the interest cost. All 3 options slow economic growth. Slower growth reduces tax revenue. Lower revenue increases the deficit. The deficit increases borrowing needs. The cycle accelerates. In this scenario, gold benefits not because of inflation, but because the opportunity cost of holding a non-yielding asset declines as the economy weakens and investors begin pricing in the inevitability of Fed intervention. Central banks, which have purchased 1,037 tons in 2023, 1,045 tons in 2024, and 863 tons in 2025, are positioning for this scenario. They are not buying gold because they fear dollar collapse next month. They are buying because they have concluded that the arithmetic of the debt cycle makes some form of currency debasement inevitable over the next decade. Scenario 2, the Fed intervenes. Treasury yields are capped through yield curve control, or quantitative easing is restarted under a new name. The government is able to refinance at suppressed rates. Interest costs remain manageable. The budget deficit stabilizes, but the cost of that intervention is currency creation. The Fed's balance sheet, which peaked at $9 trillion in 2022 and has been reduced to $7.2 trillion through quantitative tightening, begins expanding again. In this scenario, gold benefits because the expansion of the monetary base dilutes the purchasing power of existing dollars. This is the 1970s playbook. The Fed held interest rates below inflation for most of the decade to prevent a debt crisis. The result was persistent inflation and gold rising from $35 per ounce in 1971 to $850 in 1980, a 2,329% gain over 9 years. Both scenarios lead to the same structural outcome. The value of dollar-denominated fixed income assets declines in real terms, and the value of hard assets that cannot be printed, gold, real estate, commodities, appreciates. The only variable is the timeline. Scenario 1 takes longer but ends in the same place. Scenario 2 arrives faster but with more visible monetary expansion. The $9.2 trillion refinancing wave is the forcing function that determines which scenario unfolds and when. And the signal to watch is not the debt level or the deficit. The signal is the Treasury auction results. Every month, the Treasury publishes the results of its bond auctions. The bid-to-cover ratio shows how much demand existed relative to the supply offered. A ratio above 2.5 indicates healthy demand. A ratio below 2.0 indicates weak demand. In the past 6 months, multiple Treasury auctions have recorded bid-to-cover ratios between 2.0 and 2.2, the weakest demand environment since 2008. The November 2025 auction of 30-year Treasury bonds saw a bid-to-cover ratio of 2.08, barely above the threshold that triggers concern among bond market participants. The January 2026 auction of 10-year notes came in at 2.15. These are not crisis-level failures, but they are warning signals. When the world's safest asset, backed by the full faith and credit of the United States government, struggles to attract buyers at yields above 4%, the message is clear. The market is demanding compensation for risk that did not exist a decade ago. When demand weakens, the Treasury must offer higher yields to attract buyers. Higher yields increase interest costs. Increased costs force more borrowing. More borrowing increases supply. The cycle continues until either demand increases, which requires foreign central banks and domestic institutions to reverse their current trend, or the Fed steps in as buyer of last resort. The auction data is telling a story that most investors are not reading. The bond market is not pricing in a strong economy or confidence in U.S. fiscal policy. It is pricing in supply and demanding a premium to absorb it. That premium, the 4.25% yield, is the market's assessment of the risk embedded in holding long-duration dollar assets during the largest peacetime debt refinancing in history. And here is the detail that should alarm every investor holding dollar-denominated retirement accounts, pensions, or savings. The $9.2 trillion refinancing wave is not a one-time event. It is the beginning of a structural pattern. The debt issued during the 2008 financial crisis, the COVID pandemic, and the subsequent stimulus programs is now maturing. For the next 5 years, the Treasury will face annual refinancing waves of $7 trillion to $10 trillion as short-term debt rolls over and long-term debt matures. This is not a spike. This is the new baseline. And the interest rate environment in which that refinancing is occurring is fundamentally different from the environment in which the debt was issued. Rates were near zero in 2020 and 2021. They are above 4% today. The mathematics of that differential compounds annually. By 2030, if current trends continue, the United States will be spending over $2 trillion annually on interest expense alone. That is more than Social Security, more than Medicare, more than defense. Interest on the debt will be the largest line item in the federal budget. And every dollar spent on interest is a dollar that cannot be spent on infrastructure, education, research, or any investment that generates future economic growth. The debt bomb is not the explosion of a single event. It is the slow strangulation of fiscal flexibility until the only options remaining are the ones no politician wants to choose and no central banker wants to implement. Gold is not rising because of fear. Gold is rising because central banks that manage trillions in reserves have concluded that the mathematics of the US debt cycle are unsustainable and that diversification away from dollar-heavy reserve portfolios is a necessity, not a speculation. China holds 2,300 tons of gold in official reserves. Russia holds 2,330 tons. Poland increased its reserves by 130 tons in 2023 alone. These are not trades. These are structural reallocations based on decade-long assessments of currency risk. The 9.2 trillion debt bomb is not a prediction. It is a published fact. The Treasury's own financing schedule confirms it. The interest rate environment confirms it. The auction data confirms it. And the central bank reserve allocation data confirms that the institutions managing the world's largest pools of capital have already drawn their conclusions. The mechanism is precise. Debt matures. Treasury refinances at higher rates. Interest costs rise. Deficits widen. More debt is issued. Yields rise further. The Fed eventually intervenes. Currency is created. Purchasing power is diluted. Hard assets appreciate. This is not speculation. This is the documented sequence from every sovereign debt crisis in the past century. And the United States, with $36.2 trillion in debt, $9.2 trillion in annual refinancing needs, and interest costs approaching $1.4 trillion, is in the middle of that sequence right now. Most investors will not act until the consequences are visible in their brokerage statements. By then, gold will have already repriced to reflect the monetary reality that central banks are already positioning for. JP Morgan's $6,300 per ounce target for gold by end of 2026 is not based on fear or speculation. It is based on the same debt cycle arithmetic that Ray Dalio has used to navigate every major monetary transition of the past 40 years. The debt bomb is not coming. It is here. The 9.2 trillion refinancing wave is the timer, and the countdown is already in progress.